classes, and we are so dear friends, we start with the discussion points of chapter 18, which is on index number. And first and foremost, we shall be understanding the basic concept of field which is used in finance, economics, and this concept is having multiple application in different sectors. So there are two types of index number, which is price index and the other is quantity index. We will be analyzing both of them. And the third is value index. So price multiplied by quantity. So we will look at value index. And thereafter, the three values, the last period index. The second is known as the purchase index. And there is, of course, particular formula for all these index numbers. The third is Marshall-Edgeworth index, regarding which we will understand. And the fourth is Fisher's ideal price index. And we shall see that Fisher's, for certain reasons, it satisfies number of requirements. Chain index is included in our curriculum, and therefore we will have a brief understanding of what is chain index. And when we shift the price index, what happens? What will be the consequence? What will be the calculation? This is another point of chapter 18. And last but not the least will be the test of adequacy. Now, when we talk of the test of adequacy, essentially there are four tests. First is the unit test. Second is something called the TRT, that is time reversal test. The third test is known as FRT, that is factor reversal test. And the fourth test is circular test. So we will look at these four tests and the benefits, limitations of index numbers. We definitely need to understand. Finally, please note that in the exams, based on the previous year's trend expected from this particular chapter. But this again has a very practical significance, because in different branches of economics, in finance, even in the, and there is a rise in price, what happens is the purchasing power of a particular consumer comes down. Similarly, in GDP growth, the gross domestic product of a particular country, GDP growth, this is also measured in the form of ratios. Production growth. Now, are we reviving from this, from the economic crisis, which came as a result of the pandemic? Well, there are certain indicators to show that, yes, we are moving forward and perhaps we are going to see happier times. And this is based on statistical ratio analysis of certain key factors. So it is important, please note the study material of our institute clearly mentions that it is important for students of chartered accountancy to learn the techniques of measuring the growth, rise, or the decline of various economic and business data. And later on in financial reporting, you will also learn how to report them in an objective manner. So this chapter has a very important practical application. And therefore, this chapter deals with the understanding of why we are constructing index numbers. Index number, as you'll see, and many of you might have gone through the study material, you might have studied about this chapter earlier in your college, in your school. But then the point is, this particular index number is based on a ratio. So we shall see that ultimately it is just based on certain numbers, quantities, but it's a comparison, because the base year quantity, the base year price, and the current year price and the current year quantity would be definitely considered. So the purpose and the applications of understanding the rise or decline in production, in prices, in growth, in the purchasing power, this is one of the important reasons why we are learning the concept of index number. Second is definitely we will deal with the different types of index numbers, and there are different methods of computing the index number. So we were discussing about last period's index, we have purchase index, Edgeworth Marshall index, and the Fisher's ideal price index. So there are different, and there are other types of indices, index numbers as well. For example, the Bowley's index, which is possibly not part of our material, of our study material, and not part of the curriculum. So different methods of computing the index numbers are there. And index numbers are very convenient way, if you see the slide, It's a very convenient way of measuring the relative changes which happens in the price, which happens in commodity quantity, for example, available in the market from time to time, or it can be used to compare the consumer index or the consumer trend from time to time or from place to place. So already in statistics, we have learned about arithmetic mean. It represents a set of values. Similarly, an index number, okay, an index number, if you see, is, please note that index number is used to represent a set of values over two or more different periods or localities. So this is the most important concept of index number. Now, say we are taking an example, if wheat production has gone up to 110% of the previous year's production. So last year, let us assume that the production was 100 metric ton, and now it has gone up to 110%. And if the cotton production has gone up to 105%, so again, say the cotton production was, say, something like 200, and it has gone up to 210. So which means it is basically, it has gone up by 105%, that is 5% over the previous levels. So now it is possible to average the two percentages, and we can say that on a composite manner, they have, what is happening is they have, ultimately, we can see that the 2% on a composite manner is going up by 107.5%. So this assumes, please note that in this particular calculation, it is assumed that both have equal weights. But then if wheat production is twice as important as cotton, then the percentage will be weighted 2:1. So there is a change in the percentage weight. So the average relatives, which we are obtaining through this process, is called the index number. So this is the introduction to index number. It is a set of, we will see, it is nothing but ratios. And it is a set of values which is covering or which is comparing certain key values over two time periods or two different localities. And this can be, we will see, price index, quantity index, and it can be value index. So index number is nothing but a ratio of two or more time period, because here we are looking at the current year and the base year. Now, if we compare, say that in 2010, for example, what was the price of 1 liter of petrol and what is the price of 1 liter of petrol today? That means here in 2010, we are considering the price as the base. So 2010 is considered as the base year, and 2021 is assumed to be the current year. So the price of 1 liter of petrol in the current year, that is 2021, divided by the price of 1 liter of petrol in 2010, which is taken as the base year. So this gives a price relative with regard to 1 liter of petrol. So the value at the base period definitely serves as the standard point of comparison, and this is very important. Now, we have discussed about several types of practical use, or you can say application, like the National Stock Exchange, we say Nifty. So the Nifty, the index, is nothing but it's based on index numbers. So there's a base year, there's a current year, and the price of different shares, of course, on a weighted basis, is used to calculate the Nifty. Similarly, the Sensex, BSE, Bombay Stock Exchange Sensex. Then we have different other stock exchanges. For example, the Dow Jones Index. We have the KOSPI, the Hang Seng Index in different other countries of the world. This is again the application of index numbers. In economics, we have studied, you have definitely gone through what is WPI, Wholesale Price Index, and CPI, which is Consumer Price Index. So this actually shows the power. In other words, the purchasing power of money, and therefore consumer price index, wholesale price index. If you see, when we try to understand whether the country is moving forward in terms of economic growth, these two are essential indicators. Definitely, we definitely look at areas like capital market, we look at the market capitalization, we look at where the Sensex is reaching, but then on a fundamental basis, to understand the economic robustness, whether we are making progress, what is the economic indicator, which we always look at? Definitely it is the consumer price index and the wholesale price index. So definitely this is an important area of our curriculum in statistics, which has innumerable practical applications in the later portions of your studies in the chartered accountancy course. Now, index numbers can be simple as well as, say, for example, simple as well as complex, composite. Okay, now we have one of our friend saying, what is Nifty? Okay, Nifty, okay, Kanika, Nifty is the index which is created of the shares which are traded. Certain companies' shares are selected, and this is used to compute the National Stock Exchange index, which is called Nifty. And WPI, as I just shared, is wholesale price index. CPI stands for consumer price index. And these are essential indicators of the economic growth and the purchasing power of money. And therefore, these are used widely, not just in India, but definitely in all countries of the world, to understand how the economic growth is taking place. Is there a rise in the economic growth, or are we declining? Okay, so therefore, index numbers are used in practical cases. And as we can see that, yes, you have studied about certain statistical concepts which are used for financial forecasting. Here, index numbers are also counted as one of the technique for making forecasts or inferences about the future condition based on certain calculations. Now, like for example, in regression analysis, either independent or dependent or both may be in the form of index numbers. So this is used in testing, or in applying index number is used in applying regression analysis, correlation and regression, to understand how we are moving in terms of economic strength, in terms of financial position, and so on. So there are two types of index numbers we shall see. First is the simple index. What is a simple index? Simple index is computed for one variable, whereas a composite index is calculated for two or more number of variables. And whether we take the National Stock Exchange Nifty, or the Bombay Stock Exchange Sensex, or say, for example, any foreign stock exchange, there is an index number. Similarly, for wholesale price index, for consumer price index, we have to consider number of types of variables. So just, for example, the ratio of the price of milk, for example, milk, 1 liter of milk in 2010 and 2021 may not give us an understanding of what is the exact condition of the economy. But when we consider certain essential items, milk, for example, grains, rice, wheat, bread, and different type of basic, items which we consume on a daily basis, vegetables, for example. So once we have an idea about the relative price of all these commodities, which we use on a daily basis for life, for living. So once we know the ratio of the current price divided by the base year price, we can definitely come to a conclusion as to how the economic forces are acting and what is the purchasing power of money, what is the trend in the direction of purchasing power of money. So that is why we have more use of composite index numbers. Now we will take a look at what is the next concept, and that is base period. So we will take what is base period. Right. So yeah, National Stock Exchange. Yeah, Mutalif Rahman, please note NSE is National Stock Exchange, BAC is Bombay Stock Exchange, WPI is, as I stated, Wholesale Price Index, and CPI is Consumer Price Index. Okay. Yes, Nifty, Soumya Bhattacharya, Nifty 50, absolutely. I think series, many of you are asking, Priyanka is asking whether series is, time series is deleted from your module. Now, I think as per the notification I had seen few days back, time series possibly has been deleted. Just see the final curriculum once again, and then you will be able to understand the final picture. But then it seems that time series is not included. Okay. There's one question, is there any difference between mean and index number? Manisha Tahiliani. Yes, there is definitely a difference between mean and index number. Mean is an average, but index number we will see is a ratio. But then, yes, mean, the concept of arithmetic mean, which you have already covered in statistics earlier, you will see that we shall apply the concept of mean in the calculation of a certain index number. Out of the 4 index numbers, one particular index number is such where we shall be using the learning which we have got, our understanding of arithmetic mean. Now, first is base period. This chapter is very easy because you just need to remember 4 basic formula, and the formula is not very critical because it is just ratio. Okay. Now, base period is what? The base period is considered or is arrived at very carefully. It is selected very carefully because it becomes a point of reference to compare future years. That means a base period. That means we were discussing about a situation where 2021 is the current year and we took 2010 as the base year. So if you think of a base year, we have to take a lot of assumptions, and we have to be very careful to make sure that the base period should be normal. The base year 2010 should be normal. In other words, the economic condition, the overall business scenario, the overall financial condition in the base year should be stable. So you can get a question in the exam, my dear friends, that base year should be dash. That means multiple choice. Should it be stable? Should it be unstable? Should it be volatile? Or should it be none of the above? So the answer there is base year should be stable. It should be relatively stable. It should not be affected by extraordinary events like war, like famine, like economic recession, or the best example is pandemic. Now just imagine if this is what the concept of base period is. I have a small question for all of you, and please do respond if you are able to hear and listen. Now, can we take 2020 as a base year? Now, already one particular remark has come from Atulya. Atulya has said 2020 cannot be taken as a base year because it had a huge downfall in economy. Absolutely correct, Atulya. Therefore, this is a very important question which can come in the exam. 2019-20, as we have seen with the attack of the pandemic throughout the world, not just India, throughout the world, several countries went for an extended period of lockdown, during which economic condition became very tough. Many people lost their jobs. Companies had to shut down. Share prices came down. Share prices of large companies started crashing. And the economic scenario became very tough. And this is an extraordinary scenario. Like in accounts, in financial accountancy, in financial accounting, you have read about normal item, normal conditions, and extraordinary items, non-recurring items. So this base period, if say a question comes that can we take 2020 as is it an ideal year for considering as a base period, as a base year? Answer is no. Please see in the study material clearly mentioned that the base year should not be volatile, that means going up and down, should not be unstable, should not have any economic recession, should not experience certain type of situations like war, like famine. That is any economic disaster or a man-made disaster or a natural disaster. No, the base period must not have any of these incidents, because these incidents will make the base year very, very volatile. I hope you know volatile means going up and down, fluctuating. So the base year must be more or less stable, uniform. And that is why this year is very important. Okay, this particular point.
Professor Chakravarti.
Yes, sir. Thank you, sir.
Thank you so much, Chakravarti, for nice explanation of this concept.
Thank you, sir. Thank you, sir.
And I would like to share this topic in this Unit 2. Time series was already deleted from the November 2021 examination onwards.
Okay, sir.
And whereas the questions are coming, the weightage is the same as it is for this topic is.
Okay. Right, sir. Okay. So
that
as
is
important, I'll just
4 to 6 questions may be coming from this topic. Very important examination point of view also. Rest of things you can take care of, and
right, sir.
Over to you.
Thank you, sir. Okay, so please note 4 to 6 questions can be expected from this particular chapter, and sir has just informed me that this is definitely a very important chapter. It's a very important concept to understand, and 4 to 6 questions. Also, sir has informed that time series has been removed, has been deleted from the curriculum. So we can see that this base year is very, very important, and the selection of the base year in the study material, it's clearly stated that the selection of the base year is critical. So also please see the third bullet point from the study material. It should be relatively recent. Now, if I take a base year, just imagine. So this is, I think from this third point, another question can come. We are also learning each and every point and trying to figure out what can be the possible questions for the exam. Now, please see that the third bullet point in this slide states that it should be relatively recent. Why? Now, say I'm taking current year as 2021. Can I take the base year as 1980 or 1990, for example? Maybe 1990 was very stable, 1980 was very stable, there was no famine, no war, no economic recession. So the question is, if I take a base year which is too old, then that does not serve the purpose. Because you see, over a period of time, the value of money also changes. Therefore, please remember the second important point. The first point is base year should be stable. And the second point is base year should be relatively recent. So if a question comes that please select an appropriate base year out of the following 4 options. So I'm just writing on the whiteboard. Say a question is coming where you have to select the most appropriate base year. And it is given in the question that there are 4 alternatives, say 2000, 2002, 2006, and 2012. And the question further says that all these 4 years, that is 2000, 2002, 2006, 2012, were more or less stable. That means they did not have any fluctuation. Now, looking at the second important point, which we are learning from this particular slide, you can understand that the most recent year is 2012. So if we select 2012 as the base year, it will be more appropriate. Okay. So therefore, kindly note that this is an important point which we need to keep in mind. So yes, again, for census calculation, many of you have written that yes, 2011, yes, in several cases 2011. Then even in taxation, I'm not going into taxation, you will study that later on. Now in taxation, in income tax, there is a calculation for capital gains where this base year concept is used. And there, for calculation of capital gains and capital gains tax, current year and base year. So you will get another application of index number when you will study income tax later on in IPCC intermediate level of your CA. Now we come to the 3 variants of the base, that is fixed, chain, and average. Now, first and foremost, now we come to the next point, which is selection of weights. This is a very important part of our discussion. Now, it is very important to point out that composite index number means that we are considering number of items. At the same time, we have to make sure that the index number is not just based on price, but it can have weights. It will also carry weight. Like we took the example earlier that wheat is increasing by 10%, and say another commodity, rice, is increasing by say 5%. So we can create an average. But then we assume that the weight, that is the relative weightage, is same. So here in the selection of weights, Due consideration, please note the underlined important lines which are underlined. This is very important for your understanding. Due consideration should be given to the relative importance of each variable which relates to the purpose for which the index is used. As an example, please see, now when we are computing the cost of living index, sugar, please notice a very good example from the study material. This will clear your concept. Sugar cannot be given the same importance as cereals. Now, cereals definitely are more important for a cost of living purpose. When we are trying to find out the cost of living index, we consume more of cereals. When you think of cereal, say, for example, wheat, rice, dal, for example, pulses, these are cereals. We consume more of this, but sugar is not that important. So the relative weightage of all these individual product or individual items, the weightage has to be very carefully selected. So this is the important concept which we learn from this slide, that the selection of weights in computing an index number has to be carefully decided. Then we come to use of average. I was mentioning a little while back that index number definitely uses the concept of arithmetic mean, which you have already studied before in the statistic portion. In statistics, you have studied about different types of mean. Also, in our mathematics portion, you may remember we studied about proportions, arithmetic proportions, geometric proportions. And if you kindly remember, you will recall that there also we had discussed about arithmetic mean. For example, inserting 4 or 5 arithmetic means between two numbers. And the same we did for geometric mean. So the use of average is equally important both in mathematics and statistics. And therefore, it is easy to realize that average, the concept of average, will play a very important role when we are trying to calculate index numbers. But always remember, from the index numbers point of view, geometric mean, that is GM, geometric mean, is better in averaging the relatives. But for most of the indices, arithmetic mean is used because, as you can easily understand, arithmetic mean is easy to calculate. Okay, it is easier because of simple concept, and the calculation is easier than geometric mean. Okay, now one question I'll take, Akash is asking why we cannot take sugar as weight. Sugar can be taken as weight, but the question is the importance of sugar in the index, in the cost of living index, cannot be the same as cereals. Okay, so if cereals are given a weight of say 0.7, sugar should not be given a weight of 0.6. It should be given a weight which is much lesser than that in proportion to the use of sugar, right? So therefore, we have to understand that the index we were calculating in that example was a cost of living index. So there, the selection of weights, selection of product, and the relative weight which we are giving to each of them has to be balanced and carefully selected. Now, there are some other factors. Choice of variables. So if we look at the study material, we have some additional points which we need to know and learn. Index numbers are constructed either with regard to price or quantity, and it can be with other measures, other factors as well. And we must decide that. There is an example. Suppose in the case of price index, it is necessary to decide whether to have a wholesale price or a retail price. Now, you know that if a company is producing certain products, let us say it is producing something which you all should be loving. Say it is something like noodles. Okay, it's like fast, you can eat it fast, especially when you don't have time before 2 classes, you can just have a bowl of noodles. Okay, now noodles, say for example, a company is manufacturing noodles. The factory manufactures the noodles. Okay, but then we have 2 levels before the noodle reaches our hand. So what happens in the industry? We have 2 levels. So first is, I'm just writing, say the factory. So the manufacturer. Okay, so there's a manufacturer. I'm not taking any particular name. Let me take X Limited. Okay, let's take X Limited. Now they will sell their commodities to the wholesale market. And then the wholesale market or the wholesale, say for example, the operator will send it to the retail center. So manufacturing is level 1, wholesale is level 2, and retail is level 3. So if the price, say for example, the cost at the manufacturing point is say rupees 10, okay, the wholesale price will be little higher. So what happens is, the wholesale price will be, say for example, they need to have a profit, so say it is 12 rupees. Then the wholesaler will sell it to the retailer also with a particular price, with a profit. So let it be the retail price is rupees 14. Now, when we are buying from the local retail outlet, or when you are buying something like noodles or biscuits or any commodity online, so what happens? The retailer will also add his profit. So the price we pay, for example, to buy a packet of noodles could go up to say 17 rupees. So the manufacturer, the cost of production is 10 rupees, but he sells it to the wholesaler at 12 rupees. The wholesaler sells it to the retailer at 14 rupees, and the retailer sells it to the consumer at 17 rupees. So you can see that I hope that you can understand that there are two levels. And as a chartered accountancy student, all of you will become chartered accountants in the near future. So you must know that there are two types of market. One is a wholesale market, one is a retail market. So you can see the price is different. Wholesale price and retail price is different. Now, what happens, friends? Sometimes when you might be thinking that if I buy something online, whether it's a smartphone, whether it's say, for example, something for festive season, you are buying a t-shirt, you are ordering some food online, or you want to buy some, say, for example, chocolates. Sometimes you find that, okay, if I order online, the price is less than what I would have to pay if I go out and buy it from the local retail store. Now, why is it so? Now, when it's online, what happens is, the manufacturer can directly sell it through an online medium. Okay, I'm just writing online. So the manufacturer can avoid this wholesale and retail. So if his cost of production is 10 rupees, he will sell it directly on an online platform, maybe at 13 rupees. Say, he keeps a profit of 3 rupees. Okay, so you can see that this pricing, and in the study material, if you see this particular slide, it is very, very important. We must know whether it's wholesale price or whether it's retail price. Now, one of my friend was asking in the chat box, WPI, what is the full form? It is wholesale price index. So here, the choice is wholesale prices. So therefore, always please remember that we have to be careful about the choice of variables. Okay. Shonaya, thanks for your comment. You're writing, it means in selection of weight should be in serial. No, it will be, Shonaya, I was saying that the balance, different component in the price index. Okay. It should be having a proper balance. Now, if you take the case of stock exchange index, what happens? Say they are taking 6 or 7 important companies or important industries, steel, banking, automotive, information technology, okay, then retail, real estate, then say, for example, civil aviation, okay, then say, for example, infrastructure. So they are taking 8 different sectors, and they are going to select top companies in each of these 8 sectors, and they will find out the relative weights. Now, which industry is most important for the country? If a choice is given, which industry is most important? Banking, or is it aviation? Banking appears to have a better impact. Banking has a major, higher importance than civil aviation. So banking companies will be given more weight, more weightage when the composite index number is calculated. Okay. So this is basically what we mean by the weightage. Now is the selection of the formula. Yes, the question of selection of an appropriate formula comes because we have different categories, and therefore we will now look at a quick recap of what we have studied so far before moving into the next part, which is understanding of the Lasperius index, Pasteu's index, Edgeworth-Marshall's index, and the ideal index, which is Fisher's index. So index numbers, just please check once again this slide. Okay. Mangilal has said that you are able to follow even though you have a Hindi medium background. Fine. Okay. Thank you, Mangilal. Good. See, the rules are that we have to speak in English, but I'm trying to explain in as simple language as possible. And I'm sure even friends who are from a Hindi medium will understand, because going forward, please remember in CA, ultimately, apart from Hindi, which is a very important language, we all should become very well, both in speaking English and in writing English, because ultimately, as a professional, we shall be using English more frequently, right? So that's my request to you. Please try to follow what we are trying to discuss step by step. And please see the video once again. Even if you do not understand the first time, please rewind the video later on, and I'm sure you will be able to understand. Now, index numbers, therefore, let's see a quick recap. Number one, index numbers, useful way definitely of expressing economic data. And it is a way of comparing, contrasting information, for example, current year price versus the base year price. Then we have seen that the base, the index number, is a figure which reflects price or quantity, and it will have a base year value. Base year will always be taken as 100. That means we are assuming that, yes, 100 is the assumed figure for the base year, and based on that, we will try to find out what is the index number. Now, let me take a very small example so you will understand just in a few seconds. Now, let me take this example that the base year, let us take as 2011. Okay, just 10 years back. So base year, we are taking as 2011, and I am taking one particular, say, one particular example. Let us take the example of, say, petrol. Okay. So let me assume that the average price of petrol, 1 liter of petrol in 2011 was, say, I'm just taking an arbitrary figure, say it was 55 rupees. Okay, 55 rupees. Now in 2021, let us assume that the price went up to a large extent, but then let us take around 95 rupees per liter of petrol. Okay, so from here, now what will be the index number for 2021? Now we will assume this 55, this is the base year. Okay, the underlined year, I'm just making it into a box. 2011 is the base year. And if I assume the base year as 100 rupees, then I can find out the equivalent index number for 2021. How to do it? I will just put 95 by 55 into 100. Okay, so let us just calculate and see what it comes to. So this becomes the way in which we are going to calculate and arrive at the index number. So just see that here 55 is the price in the year 2011, and we are assuming that 2011 is a year which is stable. There is no fluctuation, there is no economic recession, and there was no type of volatility in the market. So if I just calculate this, it comes to around 172.73. So I'll keep it at 173. So we can get the index number, but this is based only on petrol. So you can see that we are always taking the base year in terms of 100. That is why we take 100 in this calculation. The index number is then expressed as 100 times the ratio, not the base value, absolutely. And the index numbers have no units. Please note the last point. Index numbers has no units. Okay. So no dollar sign or no euro, no INR, nothing. Okay. Now there are different types of examples. As I said, for example, we have the FTSE share index. Then we have consumer price index, CPI, exchange rate index. In US, you have the Dow Jones index, okay, DJI. Then in different other parts of the world, we have different type of index numbers based on the stock market of that particular country. Like in India, we have Sensex, which is a short form of sensitive index. Bombay Stock Exchange sensitive index is reduced, is shortened as Sensex. So if I just write this, you will understand the entire Bombay Stock Exchange index. It is BSE, so sensitive index. And they have taken this SEN, and you can see the stock in the index sensitive ACNS and EX, so it is known as Sensex. Okay. Similarly, we have the Nifty index, the National Stock Exchange Nifty top 50. So therefore, we have different type of index numbers. Index of property, index of GDP, gross domestic product, GNI, gross national income. Even we have human development index. For example, what was the value or the salary of an officer or an employee, okay, in a particular base year versus the salary which the person is earning today. And of course, we have production index. So different types of index numbers are there. Now, price relative. Now we come to the concept of price relative, which we have already done here. So Pn by P0 into 100 in percentage will give you the price relative. And let us check this. We very important, let's check this, that we take the simple example of price index. I have already taken the example of petrol. Now let us take something else. Okay, say let me take this Pn, that is the price in the current year, and P0 is the price in the base year. We are trying to calculate price relative. Okay, so let me take Pn. Say we are considering one particular commodity. Say let it be something like a packet of chocolates, for example. Okay, a box of chocolates. Okay, which we normally exchange on festive days. So a box of chocolates, say 200 grams or 300 grams of chocolate, maybe in the current year, say is costing, say 600, just taking a rough figure. Price P0, and this is, we are taking 2021, and maybe the price in the base year was, say, 350. Okay, so this is, say, 2011. So therefore, what is the price relative? The price relative PR is equal to, please see the formula, Pn by P0 into 100. And this will be expressed in percentage. So we are getting Pn 600 by 350 into 100. Whatever you get will be in percentage, and this is the price relative. Okay. So this is an example of how we are calculating the price relative. Similarly, we can have quantity relative. Quantity relative is just given by the equation Qn by Q0. That means the quantity we are using in the current year divided by the quantity we are using in the base year, that gives you the quantity relative. And we have simple aggregative price index, which is sigma Pn by P0 into 100. So when we are aggregating, what happens? We are aggregating several prices. That means sigma Pn by sigma P0 into 100. We will take examples on this simple aggregative price index. We will see the example and you will understand even better. So let us first recap the three things we have learned in this slide. Price relative. It's relative because with regard to the base year price, we can calculate the current year price, and keeping base year as 100, we can find out what is the value of the particular commodity in today's market condition. Okay, in terms of percentage. Okay, so index number, the formula, please note, value in the period of interest by value in the base period into 100. And you can see a small graph which is given, economic activity. So year one, say the economic activity is at 110. Then year two, it has gone up to almost between 120 to 130. And then there is a decline in the third year. Please see the slide. Okay. So yeah, thank you. Many of you have got it. Akanksha, Priyanka, 171.42. Fine. Great. Okay. Also show me a very good Priyanka also. Very good. Okay. So if you see how things are moving, so the value in the base year and the value in the period of interest, that is current year. This is how we are calculating the index number, and the baseline is always 100. So the base year, baseline, we always say baseline economic scenario. So it's always 100. And if it increases beyond 100, it's a growth. If it declines below 100, it becomes definitely, if it falls below 100, it's a negative growth. That means it's not a development, it's a decline. Now, let us take this slide now, and we will see we have taken some prices of price of milk. Now, 1982, say, for example, the index number is we have taken as 100. And say a liter of price in the year 1982, liter of milk in the year 1982 was costing 1 rupee, and 1983 it was 1.25. 1984 it was 1.5, and in 1985 it was 2 rupees per liter, just assuming. So index number 1982 100 is the base. Just see this slide, and I'm sure it's easy for you now. 1983, the formula is what? Pn by P0 into 100. Pn is what? The price of milk in 1983. So it is 1.25 divided by the base year price, which is 1 rupee, multiplied by 100, you are getting 125 as the index number for 1983. But please note, this is based on only one commodity, and that is milk. Similarly, for 1984, you can see the calculation is easy enough. 1.5 by 1 into 100 gives you 150. And similarly, for 1985, it is 2 by 1 into 100, which is 200. And therefore, the base year 1982 is taken as, the index number is taken as 100. Now let us see one more example, and this time we are taking the formula. You can see the formula P01. Now, what does P01 mean? Later on, you will see something called P10 also. So let me just make you a little bit familiar with this term. Now, P01, as you can see in the formula, it is equal to sigma Pn by sigma P0 into 100. Fine. Now, P01 means the price, okay, the price of that commodity in the current year over the base year price. And the base year is taken as 0. And the current year is taken as 1. So this means that it is basically Pn by P0. But if it is written P10, that means it will be the reverse. That means there the base is the current year, which means the formula will be sigma P0 by sigma Pn into 100. And this is something we will use when we go into the time reversal test, TRT. Okay, so P01 and P10. So here you can see sigma P1 stands for the sum of the prices for the year for which index number is to be found, and sigma P0 stands for the sum of the prices for the base year. You can see the commodities. We have taken 4 commodities so that you understand the importance of sigma. First, I took an easy example by taking the price of petrol, and then I took the example of a box of chocolates. But now we take multiple product. So we have 4 commodities, and you can see the price in the base year. So this is how we create a basket of commodities. So commodity A price was 10 rupees. The base year is assumed to be 10. Okay. And then the commodity B is priced at 15 rupees. And the price of commodity C is 40, and the price of commodity D is 25. So together, if we calculate sigma P0, just you see sigma P0 comes to 10 plus 15, that is 25, plus 25, that is 50, plus 40, that is 90. Similarly, for each of these commodities, you can see the index number, the price in 1988. And 1988 here is the current year. So there you can see sigma P1 is 145. Therefore, the formula you can see is we are using P01. P01, that means sigma Pn by sigma P0. Therefore, 145 by 90 into 100, which gives you the index number as 161.11. So this 161.11, does it have any unit? Is it in rupees? No. Is it in quantity, for example, in kgs? No. So it is having no unit. Okay, it's just a number, but then the base year is 100. So you can compare and see how much increase has happened in the overall prices for the 4 commodities A, B, C, and D. Fine. Now another example. So we are taking quantity index number, and let us take 2015 and 2019. So the base year here will be taken as 2015. And we are trying to calculate the index number for each of the following years. 2016, 2017 and 2018 and 2019. Okay, so please concentrate on this particular slide. So 2015, the quantity was 200. The quantity index number is 100 as we assume it, and the value index number therefore comes to 100. 2016, if you see, the quantity used is 240. So the quantity index number becomes how much? 240 by 200. So here we are using both the quantity index and we are using the value index, right? So the quantity index in 2016, I'm just doing the calculation for 2016 so that you can understand. So the quantity which I'm consuming in 2016 is 240. It can be kgs, it can be quintals, it can be metric ton, whatever. So 240 is the quantity in 2016, and in 2015 the quantity was 200. So the quantity index number is given by Qn by Q0 into 100, where Qn here is 240 and Q0 is 200. So 240 by 200 into 100. So that gives me a quantity index number of 120. So if the quantity index number is 120, okay, so I can just find out the, find out the value as well. So once I get the value, so immediately I can understand the value index number calculation can be done. So here you can see that in this particular value index number, we are taking the value 12,480 divided by 10,000 into 100. So that gives us a value index of 124.8. Similarly, for 2017, the quantity is 220. Since the quantity is 220, again, the base year is 2015. So we will write 220 by 200 into 100. And we are getting 110. So therefore, we can also find out the value index. Please just try out the calculation for 2018. So here the quantity is 300 and the base year quantity is 200. So we are getting the value. If you look at the quantity index number, what we are getting is 150. So in this way, once we have this quantity, we can get the value and therefore the value index number as well. Right, so this way, what is happening is this way, we are able to get the quantity index number as well as the corresponding value index number. Now the weighted method. So after the simple method, let us see the weighted method. Now, to meet the weakness of the simplified or unweighted methods, like if I only take certain types of commodities without any weight. So what happens is it becomes it is easy to calculate. What happens is it will not be a realistic picture. So therefore, weighted aggregative index, which is important part of our exam, now has come. So we are now reaching the level of weighted aggregative index, weighted average of relatives. But now we will understand that the price of a commodity has to be multiplied also with the quantity which is used either in the base year or the quantity which is used in the current year. So therefore, the important formula, we are first going to the important formula, last period index. So weighted aggregative index means what we are doing, these index numbers are calculated in percentages, and here we are using particular weights. So we are having three very important formula which we are going to study now. First is the last period index, I'm writing L. Then we will see the past year's index, P, and so on. So the last period index, the weight which is used is always the weight of the base year. That means the weight is Q0. Q0 is the quantity used in the base year. So this will be the weight which is used. And we will see the formula. The past year's index, this will always have the weight of Qn. That means the current year quantity are used as the weights. The Marshall-Edgeworth index. So I'm writing ME. The third index, Marshall-Edgeworth index. Please note, this is the average of the base year and the current year quantity. So I can write Q0 plus Qn divided by 2. This gives me the average. Okay, please follow this working out, how we are trying to understand which weight is used for which formula. For the past year's index, it is the current year quantity. For the last period's index, it is the base year quantity. For the Marshall-Edgeworth index, it is the average. Please note this is simple average, arithmetic mean of the base year and the current year. The last one is F, that is Fisher. Fisher's index is absolutely, it's an ideal price index. We will see that. And this index is the geometric mean of last period's and past year's index, which means here the index will be what? Geometric mean. So it is the square root of Q0. Here it is Q0 and past year's index is Q1. So I can write it is the square root of last period into past year's. So this is very important. So this four, once again, please note these four index numbers which we have just seen. First of all, are they weighted index numbers? Answer is yes. It is a weighted index number. Number two is here we have the last period's index L, which uses the base year quantity, and then we have past year's index Qn, which is the past year's number, which is using the current year weight as the index. And then we have the Marshall-Edgeworth index, which is Q0 plus Qn by 2. That means it is the arithmetic mean, and the Fisher's index, which is nothing but the geometric mean. So please note that in both these cases, in both the cases, we are basically having the application of both arithmetic mean and we are having geometric mean as well. In the case of Marshall-Edgeworth index, we are having the application of arithmetic mean, and in the case of Fisher's index, we are using the concept of geometric mean. Now here comes the formula. Please note the formula very carefully and let us see what exactly the formula is. So please note the first one, which is last period's method, and it is given by P sigma, of course, sigma P1 Q0 by P0 Q0. What is P1? What is P1? P1 is the price of the commodity today. That means the current year price. Q0 is what we have just seen that for last period's index, the weight is Q0. So please note that in both the numerator and denominator, it is given by Q0. Okay. Now, therefore, P01, that is the index number using last period's method, you can see this is sigma P1 Q0 by sigma P0 Q0 into 100. Okay. And similarly, in the past year's method, now please also see that these index numbers were constructed way back, 1871, 1874. So these are used for more than 1 century, you can say. And in the case of past year's index, the weight is the current year, Qn. So therefore, the formula becomes sigma Pn Qn, that is P1 Q1 for the current year, divided by P0 Q1, where P0 is the price in the base year, but Q1 is the quantity of the current year. So this is a very important point which you have to keep in mind, because numerical questions may come from any of these methods. And we have in this slide, we are reviewing two of the important methods, two of the important types of weighted index number, the last period's method and the past year's method. Now you can see once again the formula for last period's method, and please try to remember the formula P1 sigma P1 Q0 by sigma P0 Q0 into 100. And we can also see parallelly, I hope that you can see the Marshall-Edgeworth price index number, that is P1 Q0 plus P1 Q1 divided by sigma P0 Q0 plus P0 Q1, because in the case of Marshall-Edgeworth's index number, we are taking, you can see we are taking the quantity, the weight will be what? The weight is the average. We are taking the average of both the past year's price index as well as we are considering the last period's price index as well. So there what we are doing, it's a weighted average. It's an average, simple average, arithmetic mean. Now Fisher's ideal formula is a geometric mean. So in the case of Fisher's ideal formula, since questions come on the Fisher's ideal formula, in case of Fisher's ideal formula, this is nothing but the multiplication, the square root which we are getting if we multiply the last period index into the past year's index. Now, last period index we know is sigma Pn, but the weight is Q0 divided by sigma P0 Q0. This is last period index. Past year's index is what? Sigma Pn, but the quantity will be Qn because the current year quantity is the weight divided by sigma Pn into Qn. Sorry, P0 into Qn. So we have Pn Q0 by P0 Q0. And we have Pn Qn by P0 Qn, or n can be 1, n can be 2, whatever. So this is how we are calculating the last period's price index, past year's index, and from there, once you have both of them, now if it is given that, say, after going through this formula, if it is given that you are already furnished with two important information. This is a very similar question which came in the exam. It is given that the last period's index is 140 and the past year's index is 150. Say, let's take 150. Now, what will be the Fisher's index? Okay, so therefore we can easily apply the formula Fisher's index, which means that we have to take a geometric mean. That means it's nothing but Fisher's index is equal to square root of L into P. So 140 into 150. So if you can find out the square root of 140 into 150, whatever comes will be the Fisher's index. So these are the four basic index numbers which we have to consider in this chapter. And there are some small tests like the unit test and the time reversal test. And you will see that in all these tests, Fisher's index actually satisfies the conditions and the requirements of all these tests. That is why Fisher's formula is known as ideal formula. And please note, this could be a question for the exam, that which out of the following index numbers is considered as the ideal index number? Which one is the ideal index number? Option A, is it Lasperius? Option B, is it Fisher? Option C, is it Edgeworth-Marshall? Or option number 4, is it Pastures? So here you have to understand that the answer is Fisher's index. So the Lasperius formula, once again, just have a look so that we can move on. And the past year's formula is given sigma P1 Q1 by P0 Q1 into 100, where P1 is the price of the current year, Q1 is the quantity of the current year, P0 is the price of the base year, and quantity is Q0. Q1, of course, is the quantity of the current year. Great. Pooja, yeah, good. Very good. Pooja, thanks for your comments. Pooja is WRO, so I guess she's from the western part of the country. And she has, good. I think she has said that she has cleared CA Foundation with the teaching of our sessions without taking any coaching classes. Great. Congratulations to Pooja Gajjar. Thank you. Great. Very good. So these classes, of course, are highly valuable if you follow them closely. And if you don't understand one particular part, go through the study material, see the video once again, definitely you will be able to understand. So here, please see, there's a small calculation, and this type of questions could be coming, but then it requires some calculation as well. The base year is given both in terms of price, P0 and Q0. And the current year is given, that is both the current year price, P1, and the current year quantity, Q1. So from there, we just need to calculate, what we need to calculate is P0, Q0. We need to calculate P1, Q0, so that we get the Lasperius index. And then we need to calculate P0, Q1 and P1, Q1, so that we can get the past year's formula. Once we get the two index numbers, Lasperius and past year's, so we can understand that the Fisher's formula will be a square root of that, the product of the two formulas, the two index numbers, L and P, and the Edgeworth-Marshall index. Similarly, we can understand it will just be a average, that is the arithmetic mean of these two index numbers, Lasperius and past year's. So Dorbish and Bowley's formula is not there in the curriculum, but then past year's P1 Q1 by P0 Q1. Please do remember that in case of past year's formula, the weight which is used is absolutely the weight of the current year. Q1 is the weight of the current year. And the Fisher's ideal formula, you can see it is nothing but the square root, and then we multiply it by 100 so that we are able to get the index number. Okay, so that is P01 again. Now we have the chain index number. Sometimes a question might be expected on chain index numbers. Now, chain index number is nothing but a link relative of the current year multiplied by the chain index of the previous year. This is again divided by 100. So link of the current year into chain index of the previous year into 100. So we shall see this through an example. Now, chain index is used when there is a requirement to associate these relative number to a common base year. So what happens is the relatives of each year are first related to the preceding year, which is known as the link relative, and then they are chained by a successive multiplication. So let us see this example, and we will see that here the price is given 1979. The price is 1979 is taken here as the base year, and you can see that the link relative is 100, and then we can see the chain base number is 100. 1980, what we are doing is the price is 500 by 750 into 100. So we are getting the link relative of 66.67. For 1981, once again, please see the valuation is done 650, which is the price of 1981, divided by the price of 1980, that is 500. 650 by 500 into 100, we are getting the link relative. So the link relative is done successively like this year on year, and then we get the chain base index number when we multiply the link relative into, that means you're getting, say, we are taking 1981. So 1981, the link relative is 130. We are multiplying that with the link relative of the last year, that is 66.67, and we are dividing it by 100. Once again, going to the last slide, please see the formula is link relative into chain index divided by 100. That is what we are doing. The link relative is multiplied with the chain index number, and we are dividing that by 100. So this definitely requires some detailed calculation, but the concept is important. And of course, this is part of our curriculum as well. Now we come to quantity index numbers, and quantity index numbers we have already checked so far, which is Qn by Q0 into 100, which is where Qn or Q1 is the quantity which we are using in the current year, and Q0 is the quantity which we are using in the base year. So quantity index number is nothing but we are measuring the changes in quantities and the weights. It is just similar to price index. The only difference is in case of price index numbers, we are using the price of the current year, the price of the base year, but in case of quantity index numbers, we are replacing those by quantities, of course. Okay, so the quantity relative is Qt or Qn by Q0 into 100. So if we take the base, for example, 2000 as the base year, and in 2000, say, for example, the quantity which was used is 100, and in 2003, the quantity which is used is 150. So naturally, the quantity relative or the quantity index number is 150 by 100 into 100. Okay, so we are getting the quantity relative of 150. Let us take another example and just try to find out the quantity relative. So say in 2021, a particular quantity used for production, say it is 144, and in 2015, which is the base year, so this is metric ton, 144 metric ton. 2015, the quantity which was used was 120 metric ton. So what is the quantity index? So quantity index is always equal to Q, or you can write IQ index quantity. Okay, this is equal to Q1 by Q0 into 100. So Q1 is 144, and Q0 is the quantity in the base year. 2015 is the base year. So divided by 120 into 100. So this becomes 12 by 10, and this becomes 6 by 5. So 520, so it becomes 120. So we are getting quantity index number is 120, right? Using this calculation where The quantity index, the quantity used in 2021 is 144 metric tons, and the quantity used in the base year 2015 is 120 metric tons, and index quantity is Q1 by Q0 into 100, and therefore we arrive at 120. Right. Now, last period, similarly, we can use the same, index numbers to find out the quantity index number. So here what happens, it's just the opposite. That means in case of price index, just I'm taking the example of last period's index so that you understand the difference. Now I'm just writing last period's index, L's index, and I'm just dividing into price and quantity. Please follow this, okay? Price and quantity. So when I'm finding the price index, P01, the formula is what? Sigma Pn into Q0 by sigma P0 into Q0 into 100. Because we know in case of price index, last period's index, the weight is always taken as the quantity of the base year. Now, when we are doing the quantity index, that means we are trying to arrive at the quantity index using last period's method. So the Q01 now becomes sigma Qn into P0 divided by sigma Q0 into P0. So this is nothing but the Qn is the quantity of the current year, Q0 is the quantity of the base year, and P0 becomes the weight. P0 is the weight. Just as here Q0 was the weight, now it will be P0. That means the price of the base year will be used as the weight. So this is last period's quantity index. And similarly, we can calculate. Many of you got it right, 120. Okay. So, yeah. Okay. Now you check this important question, Fisher's index. Now, definitely here you can understand that a lot of theory, lot of types of index numbers are there. And some questions can come even on theory because here important relationships are there. And we are broadly dealing with two types of index numbers. One is the last period's index, the price index and the quantity index. Now within price index, again, we have three variables, three types: last period's index, past year's index, and Fisher's index. Similarly, the Fisher's quantity index. Now, if you get a question like this, Fisher's quantity index number, so it will be the product, first of all, the square root of the product of the last period's quantity index and Fisher's and past year's quantity index. So last period's quantity index multiplied by past year's quantity index. If you take the square root, you will get Fisher's quantity index number. Now we come to value index. Well, value index is a part of our chapter, this chapter, and the value index is very similar to the index numbers we use for departmental stores. Now, let us take value index will be the formula. You can see P1Q1 divided by P0Q0. That means here, please note the weights are different. P1Q1 signifies the actual value in the current year because P1 means the price in the current year, okay, and Q1 is the quantity in the current year. So value index VI, value index. How are we going to represent value index? This is equal to sigma P1 into Q1 divided by sigma P0 into Q0 into 100. So if you are given certain certain inputs which is given to you, so P1 Q1 P0 Q0 So please remember that here, please kindly note that the weights are different. P1 Q1 means the value in the current year, today's price into today's quantity. And P0 Q0 is the value is V0, that is base year value. Current, the price is base year's price multiplied by quantity of the base year. So please remember that the weights will be different. In value index, the weights will be different. But in case of last period's index, the weight is always Q0 when we are considering price index under last period's method. The Q0 will be the weight. And for past year's calculation, the weight will be Q1. But in case of value index, it will be the weights of the corresponding years. So when we are taking P1, that means current year, the quantity will be Q1. When we are taking P0, the quantity is Q0, right? So this question, this chapter has a lot of theory, of course, and the calculations are easy because ultimately we are dealing with just a simple ratio. But please remember the ratio, the question. Now, if a quick question comes, last period's quantity index, you must immediately remember that this is not the price index. Last period's quantity index means what? Here, Q1 and divided by Q0. But what will be the weight? The weight will be price P0 and P0, both in the numerator and the denominator. So you have to be very careful about the type of index, whether it's quantity index or whether it's price index. Now, usefulness is definitely a part of our chapter. Now, definitely this index number provides guidelines. You can take intelligent guesses about the economy. And please note, if you just find in the any website, any research paper on the Indian economy, on the stock market, on whether we are reviving, okay, what has been our growth in the last 5 years? Well, you will find in every case, they will refer to certain index numbers. It can be wholesale price index, it can be consumer price index, it can be the stock market index, it can be the human development index, it can be something like human occupancy index. For example, the percentage of our population who are employed, employment index. Now, how many people are occupied? How many people are employed? So if we compare 2021 with, say, a base year 2012, and we just find out what is the percentage of people who were employed in 2020, the percentage of population versus the percentage of population who are employed in 2021, we will get a very important index number, which is going to describe the employment percentage, right? So definitely index numbers are useful in forecasting future economic activity. And this index number had certain relation with time series because index numbers are related to time series in certain ways, which helps to understand the impact of cyclical forces. Now, various companies have seasonal business. For example, an ice cream manufacturing company may not have high business during winter. Okay, a soft drink manufacturing company may have more business in summer, right? The power industry has more business volume in the month of summer. So therefore, certain businesses could be seasonal, certain businesses could be based on cyclical fluctuations, and there also index numbers are used. And for inflation calculation and deflation calculation, they are used in a wide variety. So you can see number of important applications of index numbers. Last but not the least, the cost of living index number actually measures the changes in the cost of living over a given period. So this gives us, say, for example, like if I just give you an example here, cost of living index, CLI. Now, if you can calculate the CLI, okay, now I'm just taking all over the country. Let's take Mumbai, Bangalore, Chennai, Kolkata, NCR, and let us take Pune here, P. And so Pune, Mumbai, Bangalore, Chennai, Kolkata, NCR, and Hyderabad, H. So we are taking some important cities. Now, if you find out in 2021 versus 2012, say cost of living index, that means for an individual person to stay in Pune and to have a comfortable life, what should be your total monthly expenses for a single person? Okay, a male or female. Now, what will be the monthly expenses? So if I can find out what is the monthly expenses to have a comfortable life in Pune, okay, so maybe it is, say, 30,000 per month. Maybe Mumbai, it is 40,000 per month. Bangalore, say, could be 38,000 per month. Chennai, I'm just taking 35,000 per month. Kolkata might be 29,000. NCR could be 32,000. And Hyderabad, say, I'm just taking random numbers, 31,000. And now if we find out the same issue, the same input for 2012, that means in the year 2012, to have a comfortable life, what was the total living expenses per month in each of these cities? And this is actually used. This technique is actually used for calculating the salary increment. Every company provides salary increments based on what? Based on the cost of living index. So please never think this chapter is only theoretical. Yeah, you have to know the theory. Without knowing the theoretical, you cannot jump to conclusions. You cannot jump to numericals. Every chapter we have theory. So, when you start doing problems in probability, you have to think of the theoretical formula which is used. So therefore, here also a lot of theory, but then it is very practical as well because of the calculations. So 2012, if we are having a cost of living amount, say, was 18,000, and in Mumbai, say, it was 20,000. Say, Bangalore, it was, say, again, let me take it as 17,000. Say, Chennai was somewhere, say, around 20,000. Kolkata was, say, around 13,000. NCR, National Capital Region, say it was 22,000, and Hyderabad, say it was 23,000. So from here, you can find out the cost of living index for each of the cities. So let us do it for Pune and find out. So 30,000 by 18,000. Let's quickly calculate, and we will find out the cost of living index for the entire country as a whole on the basis of an average. So just to do the calculation quickly with me and just try to see if you can arrive at the same conclusion. So I'm just trying to find out the cost of living. So I write CLI, cost of living index for Pune. Pune is 30,000 by 18,000 into hundreds. That means 30 divided by 18 multiplied by 100. So I'm getting 166.67. I'm writing 166.67. Pune's CLI is done. Now we move quickly to Mumbai. Mumbai 40,000 by 20,000 into 100. You can clearly see it will be 200. So 200. I go to Bangalore, 38,000 by 17,000. So let's write out 38,000 divided by 17,000 into 100. I'm getting, quite a lot. So 223.5. So I write 223.5. Now I come to Chennai, 35,000 by 20,000, which means 35 divided by 20 into 100. Okay. So we are doing some fast calculations. It comes to 175. We are trying for Kolkata, 29,000 by 13,000. That is 29 divided by 13 into 100. And I'm getting something like 223. Then we have NCR, 32,000 by 22,000. So this is 32 divided by 22 multiplied by 100. And this comes to 145.45. So I'll take 145.5. Last but not the least is Hyderabad. Hyderabad is having 31,000 by 23,000. So this is 31 divided by 23 into 100. And I'm getting 135 approximately. So I write 135. So this gives me two important information. First is, if you see for Pune, okay, now this is not there in the presentation. I just wanted to do a quick calculation to show you. Pune 167 roughly. So I round it up to 167. Mumbai exactly 200. Okay, Bangalore 223.5. That means Bangalore is having one of the highest. Bangalore and then Kolkata, they are having one of the highest cost of living index number. That means compared to the base year, the current year has grown by leaps and bounds. Okay, so from here, two things: which is the costliest city, or in which city the cost of living has increased by maximum. This you can find out. And if I use a different color pen, you can see in Pune it is 167, Mumbai 200, Bangalore 223.5, Chennai 175, Kolkata 223, NCR 145.5, Hyderabad 135. So we can easily see that Kolkata and Bangalore, they are emerging as per, of course, these figures are quick random figures. You can see these two cities have registered the highest growth in terms of cost of living. So I hope you are able to see how we are using this, And most important, NCR, okay, just Rangana, NCR is National Capital Region, which means Delhi, Noida, and the surrounding areas. Okay. So NCR. So you can see, first of all, we are getting two. Is it theory? Is it useless? No. We have used the same concept which we are learning for the last 1.5 hours. We have used the same concept of current year by base year. But I hope you can see how I'm applying this knowledge to understand which city is showing the highest growth in terms of cost of living, which is the most expensive city. Now you tell me which cities are the two most expensive cities. here you can see it is Bangalore and apparently Kolkata. That means here currently expensive, I mean to say the growth in the cost of living has been dramatic. Yes, for living today, yes, the most expensive city is Mumbai, going by 40,000. And who's coming next? Bangalore, 38,000. Kolkata is way back. Kolkata, you can see, is the cheapest, which is also true. Out of all these cities, Kolkata is the most affordable city to live in terms of cost of living. But if you compare it with the base year, then Kolkata shows quite a huge jump. Bangalore shows quite a huge jump, followed, of course, by Mumbai. That means you can now, if I ask you, based on these figures, that, dear friends, can you quickly create a ranking of the city in terms of which city is most expensive or which city has shown the sharpest growth in cost of living? You can do it. Secondly, if I ask you that, dear friends, can you quickly find out the average of all these figures? Let us do it and see. What is the average cost of living for the country as a whole? I am taking 1, 2, 3, 4, 5, 6, 7 cities. I'm not going into the smaller cities. The calculation will become huge. But going by the large metros, let me take and find out what is the average. So 167 I'm taking. We are going by arithmetic mean plus 200. Just do it with me. Plus 223.5, 223.5 plus 175. Plus 223 for Kolkata, 223, plus 145.5 for NCR, 145.5, plus we have 135 for Hyderabad, 135. The total comes to 1269. Now, how many cities do we have? 1, 2, 3, 4, 5, 6, 7. So I divide it by 7, and I'm getting the average comes to 181.28. So roughly 181. So this gives us a national average. I hope you can see the practical side of this chapter. Okay. And this is exactly how companies, all companies, they understand how the cities, which city is becoming the costliest to live. That means if I am trying to find a job in Mumbai, for example, or Bangalore, Bangalore has the highest index here, the cost of living index here, then I must ask for a higher salary. First of all, the absolute amount which I need to live, if I want to have a comfortable life, today it's 30,000 per month in Bangalore, 40,000 per month in Mumbai. That is one. Second is the growth, the rate of growth of the living expenses in Bangalore is the highest. So therefore, I have to ask for a higher salary. So you see, this is how we can relate index number and make it absolutely practical in all types of industries. Now, finally, we look at, before going into some of the tests of index numbers, definitely there can be wrong. If the data is wrong, the index number is wrong. So you can get a question like this: which out of the following is a limitation of index numbers? So chances of error can always happen. And definitely the second point is it gives you the broad trend, not the exact real picture. It cannot be always the exact real picture, but it gives you the broad trend. For example, we achieved a national average of 181. But the question is, if I now start adding these data for all the tier 2 cities, which are not seen as the largest, I start, say, with Kanpur, with Nagpur. Okay, say I take Nasik, for example. In the eastern part of India, Bhubaneswar, for example. Now I take Patna, Ranchi, Jamshedpur, emerging areas. Many of them are smart cities. Ernakulam, Kochi, Lucknow. Okay, so for each of the data, if I put in all the data, of course, in an Excel file or maybe using a computer, well, I might get a different picture. But then this gives us a broad trend. Last but not the least, the results definitely give you. Yeah, many of you got it right, 181.24. Thank you, great. Sania, Rangana, Manisha, Soumya, Akanksha, great. Well, this is my last session with you. It's good that even on the last day, we are putting in so much of effort, and thanks for working the problem with me, working it out. Now, the shifting of the index numbers, this is very similar to the one we did a few slides back. So the shifted price index, I don't know whether questions are, definitely whether questions might come from this part, but then this will require some calculations. So shifted price index formula is the original price index divided by the price index of the year on which it is shifted multiplied by 100. So in the case where the base period is shifted, now say for example, for certain calculations, we have taken 2005 as the base year. But after a few calculations, we want to move the base year from 2005 to 2010. So what will happen? How the calculation will change? So let us see this example and it will be clear. So this is a case of shifting of the price index. Please see originally the price index. If you consider the first year, 1980, kindly see the slide, 1980. This is the original, the base year. So the price index was taken as 100 and naturally 1981, 82, we went on. Now the shifting has taken place to 1990. Kindly note, I have indicated that with a red color. If you see the slide, red color, 1990, and you can see that the value is 140. So now comes the question, what is the formula for the shifted price index? Original price index by price index of the year on which it has to be shifted. As simple as that. So original price index is 100 for 1980 and the price index for the shifting year is 1990 is 140. So let me just divide 100 divided by 140 and multiply that by 100. What am I getting? Let me check. So it is, I'm getting 71.42. That means I have got the shifted price index. So let me take at a random, let me take 1987 and let me do the calculation here. So I'm just running this long, big calculation for the cost of living, and I'll do a smaller calculation now just to see whether this shifting price index system works or not. I'm taking 1987. For 1987, as per the slide, as per the study material, the original price index is 117. Okay, and we know the formula is very simple. The original price index divided by the shifted year. The price index in the shifted year. So here the original price index comes to 117, I think so, yes. And 1990 being the shifting year, it will be 117 by 140 into 100. Oh, I'll just work it out and check because this is difficult to do it orally. So 117 divided by 140 into 100. I'm getting 83.57. Let me check it out with the answer. 83.6 is given. I'm getting 83.57, which rounds up to 83.6. So this is what is meant by shifting of price index. Okay. Yeah, K. Supradha. I remember you. I think you are from the last batch. You got 63 in maths and passed with distinction. You've written, I was your last batch student. Thank you so much, sir, for your continued support. Great, great, great. Also, yeah, Supradha, thank you. I acknowledge and thank you. Thank you. Also, GS Jayant has said, we will be missing you. We are same here. I also will be missing all these lovely discussions with you and the interaction we are having, even though it's on our online platform, thanks to the Institute, of course. Now we go to splicing of numbers, and splicing actually means, this is the last part, splicing of the numbers means that two sets of price index numbers covering different period of time. Now this, how to do splicing? Now it might be necessary when a new method of calculation, or say in the original price index, some new commodity has to be included. Okay, so shifting we have seen, the last one is splicing. Splicing of index numbers, let us take this example. Old price index was 1990, it was taken at 100, and you can see the prices for 91, that is the index number for 91, 92, 93, 94, and 95. Okay, and then you have the revised price index. 1995 is now revised at 100. So assuming 1995 as 100, we can calculate the same for the remaining years, as well as basically for the years between 1990 and 1994, and also from 96 till 2000, using the same formula, spliced price index, which is given. Just follow the study material and you will be able to do this. But very few questions might be coming on splicing. The more common questions are definitely on the 4 types of index numbers: Lasperius, Parse-Chase, Edgeworth-Marshall, and of course the Fisher's ideal index. And sometimes theory questions could also come. I have selected few of the important questions. We will take it up very shortly. Now the last part of this chapter is test of adequacy. This is a mathematical proof, but of course, in our type of exams where you get MCQ, well, definitely for 1 mark, I don't think there will be a question on proving, but it's always MCQ. So you have to select the right alternative. But we must know what are the 4 tests. Unit test is very simple. The test requires that the formula which we are using as a price index number or as a quantity index numbers. So what is the unit? What is the focus? Is that the formula should be independent of the unit in which the price and quantities are quoted. So this is a very simple test. The time reversal test is a bit, you can say, what to say, I'll use the word challenging, a bit challenging, but then you will understand in a few moments. So I was discussing that the price index, once I say it is P01, that means the formula will be sigma P1Q0 and divided by sigma P0Q0. That means this is 1 on 0. And I'm using Lasperius method. Now, if I write P10, so it will be just the opposite. And test of adequacy means, the test of adequacy means what? It means that P01 multiplied by P10 should be equal to 1. That's all. So once which index number out of the 4 index number will satisfy the unit test and the time reversal test. Okay, so the price, if you see the index number P01 into P10, this should be equal to 1. Now, Lasperius formula, if you just work it out, Lasperius formula will not satisfy the test here, P01 into P10. Pasteur's formula also will not satisfy. The only formula which will satisfy this is the Fisher's ideal formula. That is why it is called the ideal formula. So time reversal test will be like this, P01 into P10 should be equal to 1. So this is the time reversal test. In short, we call it TRT. So here we have seen this was P01, but in case of P10, what will happen? P10 means we are trying to find out the price and the quantity will be adjusted, keeping in view that now P1, the current year, will become the base. If the current year becomes the base, then it will become sigma P0. Okay, now Q0, so it will become Q1, and in the denominator, it will become P1 and Q1. So we are getting P1 Q0 and P0 Q0, but here it becomes the current year is the base. So current year is the base. So therefore the base is here, and we know the current year quantity, the base year quantity will be used. So we have taken Q1, Q1, it becomes P0, Q1, P1, Q1. Now, if you multiply, you can see this is never going to be equal to 1. Sigma P1 Q0 by P0 Q0 into, so there's a multiplication sign, okay, into P0 Q1 by P1 Q1 will not be equal to 1. So Lasperius index will not satisfy. Pasteur's index also will not satisfy. The only formula, the only index number which will satisfy the time reversal test, please remember, is the Fisher's index. And in the word of Fisher, if you see the gentleman who formed this, who discovered this test, the test is the formula for calculating the index number should be such that it will give the same ratio between one point of comparison and the other. So it is nothing but P01 into P10. Now, TRT, if you just check it out, I was talking about Lasperius index, P1Q0, P1Q0 by P0Q0. Yes, we have done it, P1Q0 by P0Q0. P10 is P0Q1, and in the denominator we have P1Q1, so it will not be equal to 1. Similarly, Pasteur's index, if you try it out, it is also not going to give you 1. It is unequal to 1, and therefore Pasteur's index is not an ideal number, ideal index number, because it does not satisfy the time reversal test. And what about Fisher's? Why is Fisher's known as the ideal? Because of this. If you just see this slide, you will understand the proof that Fisher's index number is satisfying the time reversal test. You can try it out if you get some time, you can just try it out after the session is over, and you will find that P01 into P10 will be equal to 1, which means Fisher's ideal index will satisfy the time reversal test. Last but not the least, we have the factor reversal test. Now, factor, so much of theory is there because this chapter is very interesting, as well as a chapter with wide practical applications. But yes, a lot of concepts are there. Factor reversal test means the product of the price index and the quantity index should give you the value index. As simple as that. Now, what is value index? We saw. I was explaining the value index, and I told you that the value index, V, the VI, value index. What is value index? Value index will be sigma Pn, or I'll take it 1, P1 Q1 by sigma P0 Q0. That means price of the commodity today and the quantity I am consuming today, that is in the numerator. Today's value, price of today multiplied by quantity of today. So I can write this as V1, value of today. In the denominator, we have P0, Q0. P0 is the price in the base year, Q0 is the quantity in the base year. So if you multiply that, it is basically V0. So the factor reversal test says that for any index, whether last period's index or for the past year's index, if, or even for the Fisher's index, if the PI, price index, multiplied by the quantity index, if it is equal to VI, so this is known as FRT. That is factor reversal test. You could get a question also from here, that which formula shows you factor reversal test. So the formula will be PI into QI, that is price index into the quantity index should give you the value index. Here also, dear friends, please note only the Fisher's index will satisfy the factor reversal test, the others will not. And this is the reason why Fisher's index is known as the ideal index number, simply because it is symmetric and it follows time reversal as well as factor reversal test. You can try it out with Fisher's index, and you can see that it will definitely give you the true value ratio. Okay. There is circular test again, and the last part before we move on to some of the questions. And this is circular test is just concerned with the measurement of different price changes over a period of number of years. So if you see the study material 1970 index, so if the 1970 index with a base of 1965 is 200 and the 1965 index with base 1960 is 150, then we can understand that the index of 1970 on the base 1960 should be 300. So this is nothing but the circular test, and the test of this shiftability of the base is called the circular test. So we are having 3 years in this example, and the years are 1970, 1970, 1965, and 1960. 1970, the index is 200. Okay, the index is 200, but the base is 1965. So we will take it as 100. And 1965 index is actually 150 with regard to what? With regard to 1960s base, and 1960s base in that case will be 100. So 1970 to 1965, we know the link is 200. 1965 to 1960, we also know. Now we have to find out the circular test. That means what is the relationship between 1970 and 1960. So this is nothing but it will be 200 into 150. So you can just see here the base is how much? 150, and here the base is 200. So therefore, the direct, if you look at the direct base, if you shift the base, shiftability of the base, what will happen? It will become 150 into 200 divided by 100. That means 1 cancels and this 0 cancels. So we are getting 15 into 20, that is 300. Okay, so this is the circular test. And yes, which formula will give you the circular, will be holding good for the circular test. So this test is not met by Lasperius or Pasteur's or the Fisher's index. This is only possible the simple geometric mean of price relatives, and the weighted average price relative will meet this test. So please remember, circular test, if a question comes, circular test is achieved or is satisfied by which of the following index numbers? First is Pasteur's, second is Lasperius, third is Fisher's, fourth is none of the above. So here the answer is none of the above. Now the selected questions with which we are ending this chapter. So index number for the base year. So I have selected few questions from the study material as well as from the exercises. So you also have an AQB and I think a question bank in this chapter. Please go through that. And definitely I've taken some questions from the mock test paper and previous years questions in the exam. I've created around maybe around 15 questions, which we shall look at. Most of them, of course, are based on your concept and understanding because calculations are quite easy here. If you get a question like this, that the past year's index is given and the last period's index is given, you have to find out the Fisher's index. Well, that is very simple. Just multiply them, get the square root, multiply by 100. Index number for the base year, let us see the options. Index number for the base year is always considered as what? 100, 101, 200 or 1000. Well, we know that index number for the base year is always 100, whether it's quantity index or whether it is price index. So the answer is option A. The second question is, which index number is called the ideal index number? I think we have referred to it many times. Is it last period? Is it past years? Is it Fisher's or is it none of the above? We have discussed many times that Fisher's index is known as the best possible index number because it satisfies every test. Last circular test, it does not. Apart from circular test, all tests are satisfied by the Fisher's index number. That's why it's an ideal index number. The third question, index numbers are also known as what? Is it an economic parameter? Is it a constant? Is it a parameter or is it none of the above? Well, I would think it's not a constant. Is it a parameter? Not really. Is it an economic parameter? Yes, because we calculated the cost of living in so many cities. And we were discussing about price relative. We considered examples like bread, milk, and petrol, and wheat. So definitely it's an economic parameter. So answer 3, you can see 3 is the answer is A. The fourth, and you can get, let me also tell you that I was looking at the past questions and the questions in the MTP on this chapter, and a lot of theory questions were there. So my request to you, please go through the theory part. Please do not jump only to the numerical solutions, because you see here the numerical solutions will depend on your understanding of the theory. So please do not forget to go through the theory. In last period's price index number, weight is considered as what? Quantity in the base year, price in the current year, price in the base year, or none of the above. You remember last period's price index, the formula is sigma P1 Q0. So the weight is always the quantity in the base year, Q0. So for the answer should be option A. Yeah, the answer is A. The fifth question, Fisher's price index number is what? Is it the arithmetic mean of last period's and past year's index? No. Is it the geometric mean? Yes. Is it the difference between last period's and past year's index? Not at all. Is it none of the above? So Fisher's index we have seen is nothing but the square root of the product of the last period's index and the past year's index, and we multiply that square root by 100. So option B is the right answer. Index number can be used for what? Okay, number of properties are there. Is it used for forecasting? Is it used for fixed price determination? Is it used for a constant price computation? None of the above. Well, the most important advantage of index number is that it can help you in forecasting, economic forecasting, business forecasting, financial forecasting. So forecasting is the answer, 6A. The seventh question, I think there's a numerical. Last period's index is 110, past year's index is 108. I think we have done this problem very similar to this. What will be the answer to past year's ideal, Fisher's ideal index? Okay, so we know Fisher's ideal index is the square root of the product of last period's index and past year's index. Just find it out and check. Options are given. I'm not working this out. I just check the answer. So just to find it out, 110 into 108, take the square root and just try to see the answer. So it should be, I think, 109, which is option B. Which of the following formula satisfies the TRT, that is the time reversal test? Last period's index, no, it does not satisfy. Fisher's index, yes, it is the only one which satisfies the time reversal test as well as the factor reversal test, but not the circular test. So Fisher's is the answer. We know don't even have to look at the other options 6B, 8B, sorry, 8B. The ninth question, purchase price index number is also called what? Achha, let's see the alternatives. Base year weighted, current year weighted, consumer price index, or none of the above. Well, purchase price index, you remember the weight we take is the weight of the current year. So it is Q1, okay? Therefore, the current year weighted. So ninth question option should be B. The 10th question, while computing a weighted index, the current period quantities are used in the dash. So let's see the options. While computing a weighted index, so please note it's not a simple index, a weighted. Now, the current period quantities, okay. Is it the Marshall-Edgeworth method? No. Is it the Fisher's ideal method? No. Is it the purchase method? Yes. And is it none of the above? Okay, so the answer is purchase method, because there we use the current year quantity as the weight. So it is option number C. We move on to the next question on MCQs, a series of numerical figures which shows the relative position is known as what? Is it index number? Is it relative? Is it absolute number? Is it none? Well, a series of numerical figures which shows relative position. Well, it's an index number because it shows relative position, like we took the case of the cost of living. Okay, what is my salary in the current year and my salary 10 years back? So that shows somewhat of a relative figure. Okay, and therefore it's index number. The 12th question, index number for the base period is always taken as 251 or 100. The answer is 100. Please note this question is repeating, so could be an important question for your exam. Third question, dash play a very important part in construction of index numbers. Well, is it weights? Is it classes? Is it estimations? Is it none? Well, here for the 12th, the 13th question, 13th question, I think, yes. Dash plays a very important part. Well, here many of them could be appropriate answers. Even classes play an important part. Estimations do play an important part. But the most important factor here is weights. Weights play an important part in the construction of index numbers. If the weights are wrong, if the weights are not realistic, if the weights are not logical, you will get a value, but the value will not be useful, because the index numbers will not give you the true picture. Okay, so therefore weights is the right answer. The 13th question, dash is particularly suitable for the construction of index numbers. Harmonic mean, arithmetic mean, geometric mean, none of the above. Well, for the 13th question, it should be 14, I guess 14th. Yeah, 14th question here. Dash is particularly suitable for the construction of index numbers. Well, both AM and GM are suitable, but GM is preferred. Okay, GM is preferred. Index numbers show dash changes rather than absolute amounts of change. Is it relative change, percentage change, both, or none? Well, index number shows you relative change, and definitely it can be converted to percentage as well. So ideally it shows you relative changes. It does not show you absolute change, but shows you relative change. 14th question in the slide, a ratio or an average of ratios expressed as a percentage is called what? Relative number, absolute number, index number, none. Ratio or an average of ratios expressed as a percentage is absolutely an index number. The 15th question, the value at the base time period serves as the standard point of comparison. Is it false? Is it true? Is it both? Is it none? Now, the value at the base time period, yes, that is the standard point, because the base is the starting point, and that will be equated with 100. So this statement is true. The 16th question in the slide, an index time series is a list of dash numbers for 2 or more periods of time. So index time series is a list of dash numbers for 2 or more periods of time. It is a list of index numbers. Time series, of course, is not there in the curriculum, but then index time series is actually a list of all index numbers which covers particular spans of time. Right. The 17th question, the price of a commodity in the year 1975 and 1980 were 25 and 30 respectively, taking 1980 as the base year. What is the price relative? This is a simple calculation. I think you can work it out. The price of a commodity in the year 1975 and 80 were 25 and 30 respectively, taking 1980 as the base year. Okay, so the base year is 1980, which means the price relative will be 25 by 30 into 100. That should be the price relative, because we are taking the price relative is nothing but the current price and the base year price. But here you can see that it is given that the base year is 1980, and in the base year the price was 30. So we will take 25 divided by 30 into 100. That is giving us 83.34. Since none of the options, option A, option B, option C, they are not close to 83.34. So the correct answer is option D, none of the above. The 18th question, purchasing power of money is what? A reciprocal of price index, equal to price index, unequal to price index, none of these. Well, the price index shows the increment in the price of a commodity, and the reverse of that shows the purchasing power of money. So as the prices go up, it shows the purchasing power of money is falling. For example, to buy, say, a bottle of cold drink, okay, a bottle of a 1 liter bottle of cold drink, maybe 5 years back, the price was 30 rupees. Today, I'm spending 50 rupees. So what has actually happened? The quantity is same. Okay, the product is identical, same, but then I'm ending up paying 20 rupees more. So I used to buy the product at 30 rupees 5 years back. Today, I'm spending 50 rupees for the same product, which shows that the price has risen and therefore the purchasing power of money has fallen. Okay, so it's a reciprocal of the price index. The last two questions, the cost of living at two different cities can be compared with the help of what? Value index, consumer price index, volume index, or unweighted index. Now, this is definitely value index will not help us. The consumer price index will definitely help us, or the cost of living index might help us, like we did few minutes back when we were considering and comparing 7 cities in India so far as the current living cost is concerned, based on a certain cost which we had to incur a few years back. The last one is Fisher's ideal index number is the geometric mean of which of the following? Is it Las Piñas and Marshall-Edgeworth? No. Is it Las Piñas and Pasches? Yes. Pasches and Marshall-Edgeworth? No. And none of the above is also not the right answer. So the right answer is the ideal index, Fisher's ideal index number is the geometric mean of the Las Piñas and the Pasches indices, right? So friends, we have done quite a number of questions which I had selected from the study material, the exercises, and definitely from some of the last year's mock test paper. And so with that, we will wind up, and definitely it was a long journey we have walked together, and it's good to see that all of you are putting in so much of effort. And please go through the study material, go through the videos, and go through the exercises at the end. Please do not forget to download all the mock test paper, and I've just seen that even the referencer is available. So please go through the referencer as well, do the problems, carry on with the exercises. Please try to go for the mock test under exam conditions. Solving the mock test, if I take 4 hours, is not the objective. Even if I get 100 out of 100, that's not the objective. The call is to make sure that you are able to solve the mock test paper within the time limit under exam conditions, and make sure that the probability of your passing the mathematics paper and of course the other papers in foundation is 1 out of 1. You remember, probability 1 means it is a certain event. Make it certain, put in all your efforts, be sincere, go through the videos, and definitely with the blessings of your parents, your hard work, and with our good wishes, all of you will be successful in the exam. So with best wishes, I'm signing off. Wish you all the best in the exams, and make sure that you take care of yourself and stay fine. Thanks a lot, and bye-bye.